Hello, welcome back. So firstly, I'd like to thank everybody who managed to get the time to see my Ample Fourth and my Aleph videos. So thank you for everyone who saw those and then decided to subscribe to the channel. I really appreciate it. If you haven't seen those, I'll put them around here somewhere so you can check them out. Also, if you didn't know, I live stream every Saturday with Peter Ing from Blocksiders Asia, and we talk about basically the crypto news, so check that out as well. So today we're going to be talking about a project that has been the second most searched crypto on CoinGecko. I'm pretty sure it's pretty high up there with the most sort of tweeted about crypto or DeFi project over the last few weeks. I'm talking about DIA protocol, or decentralized information asset. This project has pretty much dominated my week, which is why I'm putting out this video a little bit later than I normally would, because it's been very, very hectic. Anyone involved in DeFi would probably agree it's been a pretty interesting week. Together, let's go and explore WTF is DIA. Let's look into a bit of the history about DIA, starting with one of its co-founders, Michael Weber. Michael is the current association president and appears to be the main man behind this project. He claims he comes from an investment banking background. However, to be frank, it only lasted a collective 2.5 years, according to his LinkedIn, before he branched out into a more entrepreneurial kind of journey, which, to be absolutely honest, isn't really a bad thing. I'm not necessarily suggesting that is either good or bad. It's just how it is. Some incredibly good news for this project, though, is that Michael has been involved in crypto since 2014, and that's actually been documented with a number of projects he was involved in, starting with something called Goodcoin. To be honest, finding information that is accurate about this project from all the way back in 2014, when crypto wasn't that well sort of documented, has not been easy. Basically, Goodcoin was a short-lived fork of something called Blackcoin, which was a 2014 fork of something called Novacoin that was apparently the first coin to achieve a clean proof of stake system, where it was achieving between 1% and 8% annual dividends for stakers. And it's actually still trading today at about 4 cents. This was actually quite common back in 2014, which we refer to as the experimental years of cryptocurrency, before it sort of started to make a big impact on the general retail space, which was, as we all know, around 2016, 2017. So back to the main point, what was Goodcoin all about? Other than the altruistic kind of view behind it about, doing good for the world and a coin for good, it did what a lot of current meme coins have been doing, which is sort of like offering rewards for people who are creating memes about the project, rewards for activities on forums, and sometimes the founders would just look at troll boxes on different platforms, and if someone had pasted their Goodcoin wallet address, they would just give them free Goodcoin. So it's an interesting kind of concept, but remember, this is back in 2014 when we're sort of in a very nascent industry. However, like most coins in 2014, Goodcoin died in 2015. This, yet again, isn't uncommon, and it's not a bad thing. I think it really adds a bit of weight to the experience, saying that Michael has sort of been there, done that, and now he's obviously improving and then moving on to something else, which is actually what he did. At around the same time, he was also involved with a business called Bonsum. This was a business that basically helped people find sustainable products. However, it's also interesting to note in a good way that this project was successfully sold, and he obviously, I imagine, made a decent exit. After this, he was involved in a project called Biteasy, which provides Bitcoin, Block Explorer, wallet, and Bitcoin merchant services. So this is where we start to see how maybe he went from where he originally started in crypto, and we start to see the idea of what DIA ends up being, which I'll talk about later, being formed. Because generally, if you had a look at my Ample Fourth video, we see that these things don't just spring out of nowhere. It's interesting to see how the journey evolved to get to the idea that we're currently talking about. So again, it's here we can see how Michael may have started out experimenting with a fork of another chain to do something good in crypto, and then started to evolve into a more data-driven approach, because both Bonsum and Biteasy are fairly data-centric businesses. So like I said before, these things don't just come out of nowhere. And that's actually an important reason why we look at the history of these projects, because we want to make sure that there's been a clean path to success, or not even a clean path, that there has been a path. as opposed to someone, drawing out an idea on a napkin in the back of a bar and then going and raising a bunch of money off the back of that, which hasn't been the case here. So let's have a look at DIA itself. The first mention of DIA was in about August of 2018 when they first opened their Twitter account, shortly followed by a Medium post discussing the idea of DIA titled "A Step Towards an Open Financial Data Market." Essentially from this we learn that DIA is an Oracle project, meaning that it basically gets information from the real world and makes it available to smart contracts and other applications built on a blockchain. So some examples of this is something like I said, a decentralized application, smart contracts, DeFi projects, and in particular, what they're talking about mostly is things like lending applications like Aave and Compound, stablecoins like Maker, derivatives like synthetics, and DEXs, so decentralized exchanges like Kyber and Uniswap. So why is this useful? So a lot of DeFi projects are drawing their financial data from, either a number of sources or a single source. Obviously, there's a lot more risk if it's a single source. So for example, if I had lent, say, 100 Ether to Compound and I was borrowing another asset. So my collateral, let's say that let's say under the terms of the agreement, if the value of Ether dropped 20%, that that meant my collateral was out of sync, which means that my debt position would be liquidated. If I'm only drawing my data from, if Compound is only drawing the data from one place, so let's say they're only drawing their data from, say, BitMax. And if there's something like a flash crash on BitMax, so one person sells $500,000 worth of Ether in 1 second and just tanks the market for, say, a couple of seconds and drops it down. If Compound is only drawing their data from there, they may automatically look at that as, okay, even though Ether's dropped by 20% for only a second, they may liquidate my loan. And that's something that's actually happened in the past. Not with Compound, but with other projects. So it's important that you get sort of really reliable data that's actually brought in from multiple sources to create an accurate aggregate, which gives a more accurate description or an accurate idea of what an asset is worth. So according to DIA themselves, they are an open-sourced, crowd-driven platform powered by blockchain technology that enables the supply, sharing, and use of financial market assets and other financial data. So think of it like this. It's something like CoinGecko or CoinMarketCap that aggregates, financial data from different exchanges. However, in this case, it's decentralized, tokenized, and completely run by a community. So a really interesting thing about this is that it means that no one will get a data advantage by being, say, a premium member, or in the case of something like Bloomberg or Thomson Reuters, if you have a terminal, you have an advantage over the rest of the market. With a decentralized Oracle providing reliable financial data means that everybody gets the same data at the same time. Again, why is something like this important? And by the way, I'm not shilling this project. I try to be as impartial as I can, 99% of the time. But I think that something like this is actually important because as someone who, I've sort of been involved in dApps and portfolio management and things like that. When you're trying to draw financial data about the thousands of different coins out there, you can actually get different data using different APIs depending on whether you're going with CMC or Coin Paprika or CoinGecko. So there is actually, even in the market today where we have these aggregators, there's still not, a central point of truth where we can rely on these sort of, prices of assets, both on and off chain. It may not have any real significant impact right now, but as the industry grows, as DeFi evolves, as this industry becomes more mature, something like this is going to be incredibly important. However, I will note they're not the only one doing it, so it's not like they've got a monopoly on this stuff. Another thing to note, and for me personally, when I look at blockchain projects, a lot of projects out there don't necessarily need to be on the blockchain to be functional, or implementing blockchain or having a cryptocurrency doesn't really add value to the way it works. Again, I'm not shilling, but I really like sort of the space that these guys are operating in and the way they're using their token, which I'll talk about a bit later. But essentially, you can have a look at the industry that they're breaking into. And essentially in crypto, you've got three major incumbents being CoinMarketCap, CoinGecko, Coin Paprika. probably a few others. And then if you have a look at the main sort of, the real world space, you've got someone like Thomson Reuters and Bloomberg that really dominate that data space. So they've got these big incumbents that they can compete with. Now, because these competitors are all centralized, we can obviously all understand why something like this being decentralized, like making data equal to all, being able to ensure that through the blockchain that the data is valid, and then the way that they actually use their token is to incentivize people to provide accurate and correct data using appropriate methodologies, and then they're rewarded with tokens. And then people that want to access the data can do so with tokens. It's actually got a pretty interesting way. That's one way that the token's used anyway. And I can say that in trading and investing and pretty much a lot of the stuff that's happening in DeFi at the moment, access to reliable data, timely and accurate data can be the difference between success and an abhorrent failure. And as I've already said, in many cases, critical data can be centralized and controlled by a few privileged vendors, leading to unequal market conditions. I've touched on it briefly, but let's have a bit of a deeper dive onto how the token works. So the way they're making their token work is actually pretty interesting as well. As I said, I'll touch on earlier, dApp developers and other sort of users need to pay DIA tokens to access data, while data providers and data analysts are paid in DIA tokens to put that kind of information onto their blockchain, or within their protocol, I should say. Remember that DIA is a not-for-profit, so this is actually a circular flow of tokens, as the project doesn't take any for themselves. And subsequent price determination is actually determined by the market itself. The system is also designed to make it economically irrational for inaccurate data or methodologies to persist on the platform. And just to make it, even more great, they've also added a governance token part, which seems to be the flavor of the month of pretty much most DeFi projects at the moment. Let's get back to our DIA story. The DIA beta was released in August of 2018, shortly after they had set up their socials. They then released monthly updates, but I'll spare you from those for the sake of time. They went quiet in November 2018 to October 2018 on their Medium exchange, on their Medium account rather, I should say. But don't stress, because they were still active on their Twitter and they were busily attending conferences, helping out hackathons, and no doubt working on the project. So which is pretty standard startup life. And anybody who's sort of still been involved in crypto, 2018, 2019 was a very quiet period. However, things started to ramp up for them in September of 2019 when DIA began Outlier Ventures Basecamp Accelerator. This was a cohort focusing on Web 3.0 businesses over a 3-month period, which then took them through to early 2020. Normally I'd sort of do a bit of a deep dive on the white paper, but the DIA white paper is actually a live document, which is kind of interesting. It's available on their website. I'll put the description below. We've actually covered most of the important points in that white paper by now anyway. Then the more interesting thing that DIA has done is the way they conducted their token sale. So like most projects, they had sort of, a seed investor round, I believe, and a bunch of private sales. But then the way that they worked their public sale was via something called a bonding curve. Now, bonding curves are interesting in themselves, and I might have to do a longer video on just how they work later. But essentially, a bonding curve is a way to price and allocate tokens using a predefined price curve, as users buy tokens from the curve, and then the price increases, obviously. And as they sell into the curve, the price decreases. Now, the difference between this and a normal market is the pricing is set by a predetermined supply and demand figures, meaning that there's no order book. You're basically buying and selling to the curve itself, not to another investor. Meaning that DIA themselves set the acceleration and deceleration of price increases depending on when people bought on the curve. So in the case of DIA, any unsold tokens would be burned, and the price of the curve ranged between about 5 cents if you're really lucky, and then up to $6.9. The curve ran from the 3rd of August and finished on the 18th of August. I'll be honest, I was watching it on the day. I'm pretty sure it opened like after the bonding curve had finished and they'd burned the tokens. I think the price was sitting at about $2.20. Don't quote me on that exactly, but it was around that point somewhere. Since then, it was only a couple of days ago, but since then trading has gone as low as $1.80, and that was sort of where we found our bottom. and up to a high of about $4. At present, I looked at the chart before starting this video, I think the price was around $3.70. So look, it'll be interesting to watch over the coming weeks to see what happens. Now, they've already got a number of partnerships in place, to provide data to a number of different DeFi and dApp solutions. But it will be interesting to see how they further evolve, especially in the way that they sort of work their token. Because it's going to really be interesting to see how they pick up users, both dApps and other third parties wanting to use their data, as well as data providers wanting to give DIA data in exchange for DIA tokens. I guess the real critical time is going to be when they release what they call their proof of truth scheme, which comes out in December 2020. Basically, this is where smart contracts who use DIA as their oracle are rewarded with tokens. And later, they're going to implement something called proof of use, where a proof of truth smart contract can opt to distribute DIA tokens to the users of that contract. So hypothetically, a dApp developer who is participating in a proof of truth can actually, instead of taking the tokens to themselves, provide those to the users of their smart contract or their application to incentivize them to use the application. Now, there's a few other things I haven't really had time to mention today or cover off. A few of those things are things like the way their governance token works. If you have a look at any other project, it's fairly standard. You vote on different things to change the protocol as time goes on. Basically, with staking, you stake to validate data. And then there is an economic incentive for you to provide or to be staking with accurate data, and an economic disincentive to be staking against incorrect data points. As if it's found out that you're not doing the right thing, similar to how proof of stake works with Ethereum. If you're validating bad blocks, in this case if you're validating bad data, you can lose what you're staking. So that's my brief explainer on DIA. I hope you enjoyed it. So if you sort of like these things, as always, leave any comments. I've had a look at the comments from my Ampleforth video, so I'll have a look at some of those projects for future videos. However, if you have any suggestions, please don't hesitate to ask. As always, this is not financial advice. I'm not suggesting that you go and buy DIA. However, almost as a public service though, what I'm going to do is put their contract, the correct contract, in the description below, so that if you are interested in looking at it, you'll be getting the right contract and not getting into some scam or something. So despite that, in my personal opinion, DIA is a really interesting project. I'm really interested to see what's going to happen when they start implementing this proof of truth sort of incentive, to see how people react to using DIA and then having that in their smart contracts. It'd be interesting to see what that does to the price as all these tokens start to go out into the market. However, also remember that, people are going to want to be using their data, so that's sort of where the buy force could potentially come from. However, it'll be interesting. So if you have any questions, please leave them below, and look forward to seeing you on the next one. Thank you.